Good afternoon, everyone. We'll get started here in just a couple of maybe 30 seconds or so. We're going to let some people roll in before we get started.
Awesome.
Yeah, so
Good
you're home.
afternoon, team. Good morning. Good afternoon.
Yeah. Where were you that you've been gone from home for a period of time? Were you all over the place
Um,
or in one
all
location?
over the no, all over the place. But I'm in Dallas right now, and then I fly in a couple hours. I fly to Portland. We're visiting branches. I was in New Jersey, so I'm just doing the kind of end of year branch tour, visiting with our branch leaders and our division leaders, and checking in, making sure everybody's you know attacking the end of the year. And it's been a blast.
So I thought that maybe you were home, but you're truly not even home yet.
No, nope, nope. I'm sitting in the lobby of a Marriott in Dallas, and then I don't go home until I won't be home until Friday this week. So it'll be a full two weeks out.
Wow, that's a lot, but I know a lot of people do that at the end of the year, and I'm sure that's greatly appreciated by your team. So, well, let's get started. Thanks everyone for joining us. This is the last week in mortgage today. If there's anybody on here that I have not met yet, I am Faith Howard Mooney, the SVP of Member Engagement at the Mortgage Collaborative. And I have with me a new friend, someone that I just met last year at secondary. And I can't believe that I didn't know you in the industry. And it makes me kind of sad to think that I didn't know you before then, but I'm so happy that that happened because of our mutual friend, Josh Katz. But Danny Horanyi, who is the co-creator of Neo Home Loans, which is part of the Luminate Bank network of companies. So thank you for doing this with me, Danny.
Oh, it's my pleasure, Faith. I'm really looking forward to it.
Yeah, so please share with us like a few words about you and about Luminate and kind of what you see your mission is in the industry.
Yeah, thank you for asking. So, my business partners, Ryan Grant, Chris Ledley, Josh Metal, and I started Neo Home Loans in 2020. And our our intention when we set out to do that was to improve communities through financial literacy. We learned that only 1 in 9 families will seek the advice of a financial planner, but all of those 9 families are interested in homeownership and the American dream, and they seek the advice of a mortgage advisor. So we found that we can use our exposure to those families as a conduit to help them better understand their finances, break generational curses, and truly build wealth over time.
That is fabulous. What a fabulous mission to have and so needed right now with the economy and where the industry is where it's at is positioning people for when they're ready and get them going for sure. You just very recently attended your first conference with us in Denver. And I would love for you to just share with me. We were talking a little bit before we hopped on here, folks, and I would love for you to share with me kind of like what you think the most impactful thing that you had happen while there, your favorite thing, fun or work,
Yeah.
for one.
Um, so I'll start with the session. My favorite session was absolutely the Collab Lab. This is a group of other mortgage executives get together in a room and just talk about the current state of the industry, current state of everybody's business. It's extraordinarily candid and open, extraordinary amount of vulnerability, honesty, and a lot of care. Everybody was there
Oh,
to share and help each other. And it was just a very refreshing experience. One of the things I say to our team often is I don't have a monopoly on good ideas. Like the best thing for us to do to create the best solutions to the problems we have, and we do have them, right? All of us do, right? This is a tough industry to be in, a tough market to be navigating through. So having more minds at the table is a massive difference maker. And I was so grateful for the experience and just the quality of character around that table. And so just to kind of give my second answer, which is, outside of the sessions, it's kind of related. The community was so welcoming. And I
yeah.
just found there's, and this might not, I'm not sure if this is on brand for you. I'm just going to share very candidly my experience. It was a hotel full of some of the best in the mortgage industry, but at the same time, there's this silliness and humility. And I was so there for it. Like it landed for me big time.
Yeah, that is always, I mean, that is always one of our goals. I love it that you said that because we did not talk about that before, folks. So that was not a plant on my part, but it makes my heart really happy, that's for sure. Is that, people get together, share their experiences. I think when we talked before, you used the word validation. It was just a lot of validation for you on what you're experiencing in the industry and kind of that you're not alone in some of the things that you're experiencing. Oftentimes during COVID, on Zoom calls and everything, people started calling it their free therapy, because it was their way of understanding that I'm not crazy. It's happening to everyone, and I'm in really good company, and we're going to try to find a solution together. Would kind of be our way that we want to do that. So something that you didn't know that happened at conference, and I intentionally did not tell you until we were on here. In our survey after conference, we asked some different questions this time just to kind of get a different perspective and different feedback. And one of the things that we asked people was, is there someone that you met for the first time at this conference that you definitely are never going to lose contact with? And you were mentioned like multiple times.
Oh, that's so awesome. Thank
Yeah,
you, everyone. That's
yeah.
fantastic.
Another one, and you got another one in the Laura Lynn. Thanks for joining us today, Laura Lynn. You got another one in the chat right now from Laura Lynn Ball at Top Flight, who was in your collab lab. Um,
Oh, yeah.
you
That was such a
definitely,
great session.
yeah. So you definitely have to come back and share with us again. For sure. So, yeah, but let's get into kind of like some of the things that we found that are happening out there in the industry today. So, one of the things, of course, that has been in the news and probably will be in the news for quite a while was flood insurance and homeowners insurance. Obviously, that's had a huge impact on people because of Helene. So, one of the articles that I found said that 1% of homes hit by Helene had flood insurance. Maybe not surprising because a lot of the areas that got hit are areas that typically have not been hit in the past. Um, Katrina, the cost of Katrina back in the day was $100 billion. Helene is expected to be at least that much. I thought it was interesting because this article that I was reading recommended that you get flood insurance if you're anywhere close to water. And I mean, I'm in Minnesota, so we have water all around us. But man, if any lake or anything got to the point that I had damage to my property, the whole state would be underwater, essentially. So it's like I didn't think that that was the best advice, and I didn't realize that if you weren't in a flood zone, that it would be easy for you to get flood insurance. Have you heard anybody make those type of statements in this current environment?
Faith, a couple things are coming up for me as you're sharing this, and this is I obviously I'm aware of, the impact of the storms. I also live in California, so I've been navigating a very difficult insurance market for many
Oh,
years now because of wildfires.
right.
My home is, now insured by the state because there's not a carrier that will insure my home because it's designated fire, in a fire zone, which is essentially the entire state now. Not exactly, but it's a tremendous amount. So the thing that's coming up for me is I think it's really important for us as financial services professionals to help our clients become successful homeowners. So that doesn't just mean helping them acquire an asset, but also it means giving them the advice and guidance that's appropriate for them and their financial situation to protect that asset. So while that might be a kind of belt and suspenders recommendation, there may be some families where that's absolutely appropriate because it's not just, okay, are you close to water and, are you potentially going to be affected by, damage, et cetera. It's what would the consequence be if that was the case for you? Like, how would you recover from that event? And if the answer is not well, then spread the risk of that over time by paying an insurance premium and spreading that risk over time. If you can, pun intended, weather the storm, right, financially, and it's not going to be devastating, then you can take a little bit more, be a risk tolerant approach. And I think now, though, and maybe I'm just like layering in a little bit of personal bias here. I think that it is appropriate to take a little bit more conservative view of insurance today than maybe in the past, because we're finding more and more cases where the 100-year floodplain is coming every 12 years, right? So it kind of isn't it's just a clever title now. It's not the 100-year floodplain. So I think people should be a little bit more appreciative of what, being on the outskirts of that might look like.
That's one of the reasons why that it was cited, the cost of insurance obviously has gone up dramatically pretty much everywhere, because that even hit me this year, even here. So I think it's had an impact, but that reinsurance, after so many events in a row, is one of the reasons why there isn't that time frame between some of these storms or natural disasters that have happened in the past. One of the things that was noted in this, which I had not heard before, was the term NatCat, which is a national catastrophic event. So instead of calling it like a hurricane or whatever, they're categorizing all of these things under NatCat. And it's a thought process that apparently is out there and growing a little bit. I'm not sure, when I read it, I had multiple feelings about it, but due to weather volatility, it was like they called it creating a social security for disasters, where every purchase that was made in the United States, they would collect a fee that goes into this fund, that then helped fund disasters when and if they happened. Um, in some places of the country, probably a very helpful thing, to help speed up recovery, maybe. But when you get a governmental agency involved in the monies involved in recovery, I don't know if that speeds it up. Maybe, maybe not. I don't know. But my first gut thought was, would people in North and South Dakota want to pay for, um, things that may never impact them every single time you fund a mortgage transaction?
Yeah, Faith, I'm similarly struggling with that. And it's not just, like I do believe in the power of like socializing risk and having that be, part of the experience of being a citizen. But when we're talking about housing, it's very local, right? And people are choosing into and out of markets, and those markets are more or less affordable, based on some of the other currencies being traded, right? And disaster propensity is one of those things. Like, I live in California, I have to think about earthquakes, I have to think about fires. I don't think about tornadoes, I don't think about hurricanes, right? Other places do think about those things. And people can pick and choose where they want to live based on their experience of that. And the cost alignment of those choices, I believe, should follow those decisions, because home ownership is already um, challenging for many families. There's hardworking people that already can't afford it. And so anything that could imply an increase in cost, to me, I'm going to naturally be suspicious of it or resistant to it, especially if it's taking costs from areas that likely, wouldn't be subject to these, disasters, and then transferring those funds to other areas that are.
Yeah, that was kind of my thought process too. The other thought process associated with that, I know obviously something needs to be done. I think everybody believes that there has to be some, if it continues how it is, it's not going to be sustainable the way it is in a lot of places. But at the same time, it's like the cost of purchasing a home is so expensive now. And we just got over the whole, well, I don't know as we're over it yet, but the junk fee the lenders are charging for junk fees, well, then you're going to add another, $200 or whatever the number is into an equation. It doesn't, for people that are trying to afford housing, it doesn't help any. That was,
Yeah.
one of my reactions as well. Along with that, in the news this week, I don't know if you've been following this when you've been on your travels, but is another potential increase in the FICO score. It's, and I know MBA is like questioning it with the amount of money that has been earned out there, but the statement is in order to enhance technology and do other things, and because of inflation, an increase is required. What do you think about that one?
Um, I think that uh, I think that the credit agencies are playing with fire here, um, and I I believe that there's a place to compensate yourself for innovation. It is expensive to invest in technology. That's very real. But I'm just doing a mental graph of the cost of credit reporting over the last 4 years, and I don't have the data in front of me, but I'd bet somebody a can of Coke that they have far outpaced the pace of inflation, and it feels very monopolistic to me, and also the pivot from soft credit pulls being less data intensive, therefore less costly, and so innovative companies lean into that as a solution to bring down cost of manufacture, which is one of the greatest challenges in our market right now. Is in all markets is bringing down the cost of manufacture. Right, it reached a peak level. I heard that some companies were iterating as high as $22,000 alone, including compensation to the originator, which is crazy, right? That's the high water mark. Average is right around the 11,000 mark. So the idea that we're going to continue to add um, cost without a material improvement to the value being created by that service, I really struggle with that, because I'm not picturing the connection between I'm increasing this fee, I'm going to invest in technology, and therefore this experience is going to be better, faster, or less expensive. Um, that hasn't happened in the past price increases as I have experienced it. So I'd be suspicious of this. It feels like profit taking, and I think the bigger that number gets, the bigger the target is to find a way to break up that monopoly.
Yeah, I kind of looked at it in a similar way. It almost seemed like it was justification of what they were going to do, not necessarily with a substantial reason behind it, but because everybody's investing in technology, it was a way that was thought that it could be explained and other people would understand. I'm not sure. Your friend Aaron D, I'm sure you met Aaron at conference. If you didn't, I would be shocked. And the two of you do need to get to know each other. Said, don't forget the money they make on trigger leads and selling our borrower data on the other side.
Yeah, absolutely. And that's an area that I sincerely hope legislation is coming soon, because it's gotten, I mean, if we think about, the consumer experience and how, there's the purpose of much of the regulation is to protect the consumer and protect their data, protect their experience.
Yep.
We've had clients receive, over 100 phone calls from having their credit pulled for a refinance. I mean,
Yeah.
that is crazy, and it's extraordinarily inappropriate, and it's not advancing commerce, right? It's destructive, not constructive.
Yeah. I always, the whole consumer choice thing, the argument there that, well, that makes it a consumer choice. Honestly, it's just like going to a grocery store where they have 350 different brands of stuff. Does the consumer always want that kind of choice? No, they want two or three, and that's it. And I feel like by the time that people have gotten to that stage where they're applying to somebody and talking with somebody, in my world, you would have done your due diligence already and you knew where you were going to go and you were serious about that transaction. And you're not really I don't want 120. and I understand what the process is. What about the people that have bought a home twice in their life? And one was 20 years ago. What are they going to understand about that? I think it almost does damage to the industry, honestly.
I I I believe that, deeply believe that. And I would take it a step further, Faith, to say that most of those that I met, I think all that I met were in some form of distributed retail, whether it be broker, local broker, or distributed retail, INB or bank, that I met at the conference. And we as a community invest a tremendous amount of time and energy in building trust with our local markets and our clients, right? It takes a lot of investment of time, money, workflow, yes, technology, but it's mostly just, a knife fight, right? You're getting out there belly to belly and creating those relationships and building trust. And those families that we're in service to, they are immediately in fear, right? As soon as they start to think about buying a home, or even if they're just optimizing their mortgage with the refinance. I'll tell you this story, Faith. When I bought my most recent home in 2017, I had just given a presentation to a realtor office called "Are We in a Bubble?" The conclusion was we're not in a bubble, right? It was a whole presentation in 2017. And then I went to sign the offer for this home, and I looked at my wife and I was like, what if we're in a bubble? Right? I like literally was the expert saying this isn't happening. So I understand that fear that gets created, right, when you're making this massive commitment and advancing your life in these really material ways. So I see these trigger lead people as predatory. They're they're finding space in that moment of fear to disintermediate those advisors that have been arm in arm with that family up to that point. And it does hurt the industry and it hurts the consumer, because that same local advisor that's truly going to invest in that person, want to see them successful because they live and work in that same area, they don't have that. They're helicoptering in a solution that is not attached to a long-term vision of advice. And I believe it's hopefully soon will be criminal.
Yeah. It's like having the approach of, and we always say that with people in our network too, even when like you're investigating a service or something, we're a relationship driven place. It's about the people. If you get into where it's just a transaction, that's a completely different spin on things. And I think that everybody in our network sees it how you saw it, as this is a relationship that I built with somebody, they trust me, and then a transactional type thing happens that it's like it's trying to like negate the trust that you've built up with that consumer. And Aaron, thanks for popping that in there too. On top of the fact that they're not giving bona fide offers of credit, that adds a whole nother dimension
Yeah.
onto the thing.
Yep. Yeah, it's undermining, right? Because they see the client sees this, 1/4% lower interest rate, and then it puts into question like, oh, why did I trust you? Are you taking advantage of me? And it starts to form these other thoughts. No, no family has ever become wealthy by saving 1/4% in their interest rate.
Oh,
Not one time. They've become wealthy because an advisor cared enough about their future to help them plan that future out, right? With a intention of building that wealth. And a call center is very unlikely to produce that level of impact.
well, and on top of the fact that if that rate is different, that doesn't necessarily make the whole transaction equal. You may not even be comparing apples to apples in that situation. So it's like, yeah, you got 1/4% different, but if it's causing you to pay $6,000 more in closing costs to get that quarter rate, it's like you have to look at everybody's unique situation, and it's everybody's in a unique position. Not all transactions are created equal, and I think by going to only rate as the only thing that people are looking at, it's kind of like you're saying your situation doesn't matter to me. This is really all that matters, and everybody's in a unique financial situation. And when you go through it personally, I agree with you. It makes you understand to like a whole different
Yep,
level. That is for sure. It's probably a good
exactly.
refresher for those of us who have been in for a while. When we go through that, it kind of gives you a little bit different focus on things and a good reminder, I guess I would say.
Absolutely.
Yeah. In the industry this week, I know this morning I just saw an announcement of a merger and acquisition with Synergy One with someone who's in our network, which is Man. They acquired Man, and that has been going on for the last couple of years. I think people are trying that are financially able to are trying to position themselves for growth. Smart thing to do, I feel like. People are culturally trying to find fits with their organization. If maybe they need an outlet to be doing something different because this has gone on for much longer than I think what people thought it was. What do you think is going to happen with mergers and acquisitions in 2025? You think it's going to
Um,
be a continued thing?
I do. I think it will continue. I think that and these are just my thoughts, right? Nobody knows with the crystal ball, but
Yeah.
I believe two things are happening in the industry that are that as leaders we need to peek around the corner and kind of make sure that we're protecting the people in our charge and finding solutions to make sure that we can create stability, inspiration, fulfillment. And one of those issues is that our expectation of rates improving, throughout this year has met a little bit of not quite the same headwinds we had last year, but we haven't gotten the big gust of wind in our sales that we were anticipating. Now, that said, industry wide pipelines are up in October. That's very exciting. Everybody's very happy to kind of come into Q4 with a little bit of juice. Um, but
Energy.
but that that idea that it was going to be kind of off to the races moment, kind of coming into this year, especially after the Fed reduced, which doesn't immediately impact mortgage rates as we all know, but it implies what the cost of money is going to look like over time, which then reduces cost of lending over time. I believe that companies are realizing that the cavalry is not coming, and that in some cases uniting to create economies of scale, efficiencies and processes, help to work to reduce the cost of manufacturing by able to scale up can be a difference maker. The other thing I believe that's happening that we are aware of and trying to navigate through is the increased cost to respond and manage the compliant business. CFPB has been very, very clear, and the volume has been turning up around fair lending, around LO comp, around, and that there's a list of their hot buttons, and these are all very appropriate things, right? Fair lending is incredibly important, right, for us to be focused on as an industry. LO comp is a important thing for us to have scaffolding around, so we don't end up getting past our skis again and putting families in bad positions because we're again not looking at the full scope of cost of manufacturing. And small to medium sized companies are going to find it more and more difficult to navigate those waters and be able to afford the cost of responding to and preparing for those audits. And so those mergers, I think, make those companies stronger and better prepared to respond.
I think it's in some instances, and you mentioned it too, because I know that you guys are about your people as well. It may be a spot where you can find more stability for your teams of people, for sure. It's interesting that you bring up the fact that there are compliance related things going on, there's CFPB things going on. The TOJ reached their first settlement ever with a credit union this past week related to redlining. In the past,
Really?
yeah, in the past, credit unions have kind of been, no, I won't say looked at differently, um, but I think that credit unions generating a lot more mortgage volume in the industry may have also, put some of them in a category where they're going to be looked at a little bit differently, not unlike a bank that grows to a specific size or that type of thing. But yeah, and it was noted in the article that I read that that it is their intent, and this is a way for them to demonstrate that they are going after all types of lender members and making them accountable for their role in mortgage. So I don't think that's the end that we're going to see of that one. I think that people that think that they're too small, they're not going to come after me, I'm too small. I don't think that's a safe zone for anybody to be playing in at this point.
Yeah, and one of our ethos inside of Neo is always make the hard right decision over the easy wrong decision, and it's a guiding principle that guides our behaviors. And this applies in this case, right? The easy road here, and it makes me kind of sick to my stomach to think that there's companies that believe redlining is the easy road. That's I didn't know we were still doing that in 2024. That like blows my mind. But the idea that there's still companies out there that would be willing to kind of engage in that kind of behavior, I sincerely hope they get regulated, and that we find a way to, level the playing field and make it appropriate for, all families, all hardworking people to have the same level of opportunity.
Yeah, agree 100% with that statement. And that is just the most awesome place for us to end today. I knew that we could probably talk for well longer than 30 minutes.
We definitely could. We definitely could. I've been training for this my whole life.
I appreciate you so much. I am so happy that you guys are part of our network. You have been so awesome. Can't wait for not only our team, but everybody else in our space to be able to interact with you, and you be able to interact with them. Thank you so much for doing this with me today. I really appreciate you, and safe travels home. Get home and
Thanks
get
so
some
much.
rest.
I will try. I will try. Have a great day. Talk to you later.
Thank you. Thanks everybody for joining us.